For 18 years, Jamie Dimon never sold a single share of JPMorgan. Not during 2008, not through the 2009 banking collapse, not in 2012, not in 2016. Every time the market looked ugly, he bought. That pattern just ended. 2 days ago, April 15th, Dimon sold another $40 million of his own bank's stock. 6 sales since late 2023. Total cashed out, more than $500 million. 0 purchases in between. A complete reversal from the man who built his reputation buying when everyone else ran for the exits. But here's what almost nobody is covering. On the exact same day, within 4 cents of each other, 7 other JPMorgan executives sold alongside him. 8 insiders. 1 tight window. Hours later, the stock dropped 2.5%, and the bank quietly cut its own 2026 guidance. I'm Marcus Reid. If that pattern got your attention, hit subscribe, because the data behind it gets a lot more uncomfortable from here. So what is Jamie Dimon seeing that the market has not yet priced in? Here's what makes this strange. Every time Dimon bought before, 2007, 2009, 2012, 2016, the market was in pain. Headlines were ugly. Most investors were selling. He walked the opposite direction. That is how he built the reputation he has today. Contrarian, patient, long only in his own bank. So the question is simple. What changed in late 2023? That is the exact quarter he filed the first plan to sell 1 million shares, right after the regional bank wave, as private credit ballooned past $1.8 trillion, as Treasury yields broke the pattern they had followed for 30 years, in the middle of a market being sold to you as calm. Think about what you were hearing in late 2023. Soft landing, Fed pivot, recession averted. Dimon moved the opposite direction of the narrative. Again, same playbook he ran before 2008, just inverted this time. Which brings us to what actually happened on April 15th, and why 8 executives moved inside a 4-cent window. Here is what happened on April 15th, step by step. Dimon files a Form 4 with the SEC. 130,488 shares sold at an average of $306.56. $40 million in one transaction. That filing hits the tape in the morning. Then 7 more filings arrive. Same day, same bank, same price range. The chief operating officer, the chief information officer, 5 other senior executives. Every single one of them sold inside a 4-cent window, between $306.55 and $306.59. Coordinated is the wrong word because these are pre-scheduled plans. But the plans were structured to execute on the same window. Someone decided months ago that this was the price worth hitting. But this is where the story changes. At the exact same time those filings were clearing, JPMorgan quietly cut its own full-year 2026 guidance. Net interest income dropped from $104.5 billion to roughly $103 billion. Within hours, the stock fell 2.5%, closing at $305.86, just below the price the insiders had all sold at. They got out at the top of the day. Retail investors found out after. Most analysts are pointing at tax planning and diversification. That is the official explanation, and it is technically true. But it does not explain why 8 senior executives at the largest bank in America all targeted the same narrow price on the same morning, the morning the bank announced it would earn less money this year. The official story answers how. It does not answer why now. Zoom out for a second. Forget Dimon personally. Forget JPMorgan as a company. Ask the structural question. Why does it matter when the executive team of America's largest bank, a bank with over $4 trillion in assets, more than the GDP of Germany, decides the exit price in advance and then watches the stock give it back to them the same day? Because JPMorgan is not just a bank. It is the plumbing. Every credit card transaction, every mortgage origination, every corporate credit line for a Fortune 500 company, every custody relationship for pension funds and sovereign wealth, JPMorgan sits underneath all of it. When the people who see that data flow in real time, who know which commercial loans are souring, which depositor flows are shifting, which middle market clients are cutting investment, when they collectively mark their own stock as fully priced, that is not a personal finance decision. That is a signal about what the data on their own desks looks like 6 months out. Here is what structurally changed. The bank lowered its own 2026 net interest income forecast by $1.5 billion. That is not a rounding error. Net interest income is the spread between what banks earn on loans and pay on deposits. When that shrinks, it means one of 2 things. Loan demand is weakening, or funding costs are not coming down the way the Fed suggests they will. Both of those possibilities hit your wallet directly, and we will get to that shortly. Quick pause here. If you have made it this far, you are already getting more than most finance channels deliver in an entire video. Drop a like. It genuinely helps the channel beat the algorithm against the fear merchants in this space. Because what comes next is the part most analysts will not touch. What is actually going through the heads of the people making these decisions. Put yourself in Dimon's chair for a moment. You run the most sophisticated risk system in American banking. You see card delinquency data before anyone. You see which regional banks are quietly leaning on the discount window. You see how many of your commercial real estate loans are being extended rather than repaid. You see the deposit flows from mid-sized banks into yours, and you know what that concentration means if confidence cracks anywhere in the system. You also see something the public does not see clearly yet: private credit. That shadow lending market that ballooned from $300 billion in 2010 to $1.8 trillion by 2025. It is not regulated like banks. It is not marked to market like banks. And it is holding an enormous share of the riskiest corporate debt in the country, the debt your own commercial clients are refinancing into right now. Dimon wrote about this directly in his April 2026 shareholder letter. He did not write it to make headlines. He wrote it because it is the thing he is watching. Now think about the timing. If you genuinely believe the next 2 years held a major dislocation, the kind he publicly warned about on BBC in October, what would you do with your personal wealth? You would not panic sell. You would set up a legal, pre-scheduled plan that steadily converts concentrated equity into cash at current market prices over a defined window. That is exactly what the filings show him doing. The decision is not in the execution. The decision is in the structure. He is not predicting collapse. He is hedging his personal exposure to a system whose tails he understands better than almost anyone alive. Those are different actions, and confusing them is how bait channels get the story wrong. But the other side tells a different story. Take this seriously for a moment, because the counter-argument is not weak. It is the mainstream Wall Street view, and it is grounded in real data. The argument goes like this. Dimon is 69 years old. His net worth is over $2 billion, with more than 90% of it concentrated in a single stock, his own company. Any competent wealth advisor would tell him to diversify. The 10b5-1 structure is not a red flag. It is literally the compliance mechanism designed to prevent insider trading. JPMorgan is coming off record quarterly profits. Earnings per share beat estimates. The bank just raised its dividend by 7%. The stock is trading near all-time highs. If Dimon wanted to signal danger, he would not be endorsing blockchain expansion, announcing a $20 billion tech investment, and publicly backing the U.S. economy's long-term strength. This view also points out something important. Dimon has been warning about storm clouds since 2022. 4 years of warnings. The economy kept expanding. Markets kept climbing. Calling every CEO stock sale a crash signal is the exact pattern recognition failure that makes bait channels unreliable. That argument is strong. It is not wrong on the facts. Here's where the gap shows up. The opposing view treats diversification and timing as independent decisions. They are not. A seasoned operator does not schedule 6 sales in 26 months at progressively higher prices unless the window to execute is perceived as finite. Normal diversification is spread across a decade. This is not that. The gap matters because it changes what the data is telling you, not crash, compression, a narrowing window, which is a very different thing, and it is the thing that hits your wallet first. So what does any of this mean for you, specifically, at your kitchen table? Start with borrowing costs. JPMorgan just cut its own 2026 net interest income forecast by $1.5 billion. That number translates directly. When the largest U.S. lender signals weaker loan demand and stickier funding costs, it sets the tone for every mortgage rate, every auto loan APR, every credit card rate in the country. If you are waiting for rates to fall meaningfully this year, the bank's own guidance is quietly telling you to recalibrate that expectation. Second, your deposits. If the signal Dimon is acting on is about private credit stress, the pain shows up in regional banks first. The exact same pattern that broke Silicon Valley Bank in March 2023. If you have balances above the FDIC insurance limit at any single institution, this is the week to check that number. Not panic, check. Third, your 401k. JPMorgan is a bellwether holding in almost every large cap index fund in America. If the stock compresses, the S&P 500 compresses with it. The ripple into your retirement account is not theoretical. Here is the uncomfortable part. The people with the best data got their exit price locked in months ago. You did not get that memo. That is the information asymmetry that defines every financial cycle, and the only real defense is awareness. Drop a comment below. Has your bank started tightening on credit lines, mortgages, or card limits in the last 90 days? I read every reply, and the pattern in those comments is often a cleaner, real-time signal than anything the Fed publishes. Two scenarios, watch both. Short term, next 30 to 60 days. The insider selling window runs through August. Expect more filings from JPMorgan executives on the same pattern, small, pre-scheduled, at elevated prices. Earnings season gives you the next real data point. Watch Q2 net interest income. If the guidance cut from April 15th widens rather than stabilizes, that confirms the signal. If it holds flat or improves, the compression thesis weakens. Either way, the answer arrives in July. Midterm, next 3 to 6 months. Two paths fork from here. Escalation path. Private credit stress surfaces in a visible default. A mid-sized direct lender marks down its book. Regional banks get retested. Credit spreads widen. The Fed is forced to cut faster than it wants to, not because inflation is solved, but because the credit channel is freezing. Probability weight in the data? Meaningful, not dominant. De-escalation path. AI CapEx keeps pulling the economy forward. Corporate earnings hold. Private credit absorbs its stress quietly through extensions rather than defaults. JPMorgan's guidance cut turns out to be a conservative hedge, not a tell. Dimon sales register as what the bank has said all along. Diversification, tax planning, nothing more. Here is my honest read. The escalation path is not a prediction. It is a risk that has been systematically underpriced by the market for 18 months, and the people with the clearest view of the data are acting consistent with that risk being real. The pattern is what it is. Jamie Dimon never sold for 18 years. Now he sells every quarter. 8 executives moved the same day the bank cut its own guidance. That is the data. What you do with it is yours to decide. If this broke something open for you, but the share button matters more than the like, send it to the person in your life who still thinks insider filings are boring. And tell me in the comments which scenario you think plays out, because I am genuinely curious how the data looks from where you are sitting. I'm Marcus Reid. I will see you in the next briefing.